a small presentation. We'll take you through the parts in this flow, and probably in the end there'll be Q&A, and we'll be happy to address questions that come. So go to the next slide, please. So as many of you know, and as we introduced, InvITs were launched in 2014 when the first regulatory framework came in. However, this was very primitive, and this first draft framework had come in. The real action around that started in somewhere in 2016, or mid of 2016 or end of 2016. The core rationale behind promoting InvITs were to encourage participation in infrastructure financing and also mobilize infrastructure financing from private sector in India to ensure that we have adequate capital to go and build the assets. Go to the next one, please. And this is where we are digging into the need. What is the need? So we all know India's economic goal is to become a $5 trillion economy. Okay. Is it better now, the voice? So we all know that India's economic goal is to become a $5 trillion economy by 2025. And to become that, we believe it will require a substantial amount of investment in the infrastructure sector. And the key challenge in this, besides the real world challenges in terms of building blocks of infrastructure, is mobilizing financing for that. Historically, and when I say historically, a decade back, so till 2010 and probably till 2001, if we were to count, majority of infrastructure financing had been done by government themselves on their balance sheet. Incrementally in 2000 onwards, we have started seeing private sector funding in different sectors, starting from power generation, then roads in different sector, and incremental financing started coming from private sector. However, majority of financing still came from the government in infrastructure sector as a whole. In addition to that, government is carrying these assets, what they built over the last 3 or 4 decades, be it road, transmission, generation, gas, several infrastructure items. So which puts pressure on the fiscal situation of the government to spend more, especially in a country like India where we run a deficit. So there comes a question that we need to mobilize financing for infrastructure asset to build future infrastructure spending for the country. Now, there are many ways to do it. However, one of the most efficient and globally acclaimed way, can you be on the last slide, please, is to achieve, can you go to the last slide, Anisha, please? Is to achieve the financing in a way that the right set of investors meet the right set of assets. Historically, these are some of the challenges that we have seen in infrastructure sector, which is long-term funding is not available, credit rating risks are there, mispricing of project. Because of all these risks, people remain away from infrastructure sector. And people, when they entered during the boom time, faced subsequently bad returns, and which gave bad name to the sector per se. However, the biggest challenge in the infrastructure sector is the execution. And the biggest mistake that the private sector as well as the government made eventually is to mix these two risks together and raise financing as a portfolio of under construction and operating assets. We believed, and also government believed at that time, if we were to separate these two modes of financing, we would be able to attract the right set of capital for the right set of assets. When I say that, what it means is to match the right type of capital or risk capital to the right type of asset to avoid all these difficulties that you see on the right hand side. If you go to the next slide, now how does one achieve this via InvIT? So first is when you do an InvIT, globally it is known as business trust, yield co, or REITs. When one does an InvIT, what it does is provides one long-term financing option for existing infrastructure project. Second, free up developer capital, including government capital, right? And as we can see, if NHAI monetizes the portfolio, they will have that much equity available to redeploy that in doing more and building more projects in India in terms of roads. So second is the most important one. It frees up the right set of capital to redeploy back by the developers to build new capacities. Third is a very important one. How do you make it a low risk investment? Now, the way to make it a low risk investment is to attach the long-term patient low risk capital to low risk asset, which means assets which are operating in nature, who are revenue generating, and therefore has less unpredictability and variability. That is primarily an InvIT is in short. Now, when you do it, the first and two becomes the end result. 3 is a mode of the result. Point number 4 is to diversify the ownership of the infrastructure asset. Now, I would stay a little bit away. No country is built in the world only on the back of foreign capital. One needs to tap into domestic capital and wide sources of capital to build long-term sustainable infrastructure in the country. Second, when we ourselves own our own infrastructure assets, we would start valuing them better. We would probably start using them better. So this point number 4 is extremely important, that how do we provide the ownership of the social infrastructure assets, which is largely road, port, water, gas pipeline, several things, to the citizens themselves and allow a wide set of assets to be owned by them. Last 2 are largely to do with when you want to make it a low-risk business, how do you instill higher standard of corporate governance, predictable DPU, to ensure that eventually the widening of investor results into a good experience and therefore deepens the capital market for infrastructure assets and investment in the country. So that is why the InvIT were framed, and that's why the InvIT came into existence. So as we go into the nuances of the InvIT, probably this will set a better context for that. So going to the next construct, sorry, we can go to the one next slide first, Amisha. Yeah. So who are the parties to InvIT? And as Bhavik mentioned, there are many parties involved and for the right reason. So InvIT, as you see as a triangle in the middle, is the trust that we are all referring to. Legally, it is a trust and not a company. And we'll explain why it is a trust, but just to make a fact, it is a trust. It has a trustee, which acts in accordance to SEBI guidelines and acts as a trustee, which is supposed to be an independent trustee. It has an investment manager, which is akin to a mutual fund company where they earn fee to do business and act on behalf of the InvIT. There are sponsors who set up the InvIT with the initial set of assets. There are investors who invest in the InvIT. And the InvIT itself, as a trust, owns the shares in the companies in form of SPVs, which are framed already, and they are acquiring those companies. So that's just to set the context of who does what. Now we can go back to the earlier slide. Now, considering that all the people on the call are fairly aware about tax structures and financing and Companies Act in India, I'll be quick. The main objective of putting this structure is twofold. Objective number 1, one of the problems in infrastructure projects and SPVs is that we are not able to extract all the cash flow from the SPV to the investors. Okay. Why? Because these are kept in legal entities like companies. Now, companies have a restriction that you cannot distribute more than your PAT or reserves. However, infrastructure projects per se do not require depreciation because you're not supposed to build them again. Either they are perpetual or they are concessions. So how do you ensure that this depreciation of accounting depreciation is also provided back to the investors to ensure that these assets are valued better? So a pass-through is something which is important. Second, to give, in India, there is a we all know there is a 1.5 taxation status, or we used to be one first tax at the company, second tax as a dividend distribution tax. How does one avoid it? So government, with these two logics, made InvIT as a trust instead of a corporation. And then the way the money flow works is something which is explained in this chart. That first is the unit holder of the investors invest via the first arrow in the InvIT. InvIT invest in terms of equity or loan in the SPVs. If it is equity, they are acquiring from the seller. If it is loan, they invest in the subsidiary. And they charge interest. In return, what InvIT earns is either interest on the loan that they have invested, or dividend if there is a profit and reserves at the SPV, or whatever loan they have given back, repayment of loan. Now, InvIT is framed as a pass-through entity, as a trust. Whatever it receives in form of either interest, dividend, or return of capital, it returns in the same form to eventual unit holder of the InvIT. At an InvIT level, for this business, there is a pass-through status that is provided by the Act. However, the unit holders pay tax in their hands depending on interest, dividend, or return of capital, and their own jurisdiction with respect to tax. Go to the next one, please. Yeah. So again, just to go in detail, sponsor is the one who sets up InvIT, transfers the initial assets. Beyond that, there is no material role for the sponsor because subsequently the InvIT is run by the manager and the trustee, and they are free to choose which assets to buy, where to buy from. Trustee is holding the asset in the benefit of unit holders. It has a fiduciary role, and it ensures that the policies are followed by the investment manager, which are in line with the SEBI InvIT regulations. Investment manager is the main entity involved over here, who decides on all material and important decisions with respect to InvIT. They're appointed by the trustee and the investor and the InvIT itself. And we'll talk about the rights and roles subsequently for them. Project manager is largely to do with the O&M of the contractor. Let's go next. This is just so key terms, or rather, let's say the introduction of key items. Unique aspects. It used to trade in lots earlier. However, with the recent SEBI circular and amendment, it is going to start trading as a single unit like equity, which is something we believe will add more access to capital and more revenues for retail investors to invest. In terms of distribution, minimum 90% of the cash flows that InvIT has earned from its subsidiary needs to be distributed to the investor. What this ensures is that the payout ratio of InvIT is not in hands of the manager or the board. It is already preset by SEBI that whatever the cash that is earned, which is net distributable cash flow in a year, needs to be distributed to its investor, which provides a predictability around payout ratio primarily. The second point is with respect to leverage. One of the second ills of the sector beyond the under construction risk in the infrastructure sector was that people over-levered. One leverage at SPV, second leverage at holding company, third leverage at parent company, and probably at different levels. This structure is built in a way to ensure that the consolidated leverage in the entire InvIT is capped at majority 70% maximum, 49% for all InvITs. Only InvITs which are able to maintain a AAA rating and obtain 75% of investor approval are the only InvITs which are able to go above 49%. In any case, however, it remains 70%. This keeps the overall risk in the system low. The next is about what investment conditions operate on the InvIT. The first one being, and this is different for public InvIT, private InvIT, but I'm focusing on public InvIT considering the topic of the day. Maximum, or rather minimum 80% of the investment that happens needs to be in completed and revenue generating projects, which means projects which has 1 year of revenue history. This is something which provides predictability, right? Because the infrastructure projects, when completed, have relatively lesser risk, and therefore the risk that is added on the business because of this clause is limited. So once looks at these 3-4 conditions that is put in place is to protect investor interest, make the InvIT platform stable, and that's what is put into the table by the regulators. Unit holder rights are like an equity holder rights. However, it is slightly higher over here because any majority acquisition, debt, related party matters, change in manager, all those items goes to unit holders for approval. So it's akin to substantially higher unit holder rights. While Avinash will be covering taxation in depth, at a high level, we've covered over here, withholding tax for NRIs at 5%, domestic investors remains at 10%. However, these changes for mutual fund, insurance companies, and FPIs for different categories. So key features. So InvITs can be listed and traded on the exchanges. Now it's written can be, but it has to be listed and traded on the exchanges. Reiterating, 90% of the net distributable cash flow has to be distributed. Trusts are pass-through status, so they are not taxed at their level, but the income in the hands of the investors is taxable depending on the jurisdiction. 80% of the assets needs to be operational and generating income at any point in time. So this is something which are unique features about the InvITs. Now I'll just touch base on what is the journey, evolution, and potential of InvITs. They started in, the first regulation came in FY15. The first InvIT got launched in FY18. And since then, the incremental assets under management has increased dramatically. And at 1,40,000 crores of just InvITs, this is kind of one of the large growth that we have seen in the sector. What is unique to see is that it is not only in one sector. We have seen roads, gas, transmission, telecom towers, different kind of sectors coming in, making different kind of InvITs and sizes. Second unique aspect is in most of these InvITs, we have seen global investors take a majority stake and taking cornerstone stakes and driving those platforms. For example, IRB InvIT Fund, the private sector one, is led majority by GIC. Indigrade has KKR and GIC. InvIT is largely run by CPPIB, OTPP. India Infrastructure Trust is led by Brookfield. Oriental has IFC and many other investors. So this is something which is where most of the large global infrastructure investors and fund managers have chosen to invest their large part of capital via InvITs. So that's something which speaks volumes about the first set of regulations which came in right. In terms of regulations, there has been a substantial evolution that has taken place. When the first regulation came in, there were many difficulties. So the lot size used to trade in minimum 5 lakh, which reduced the number of people who could invest. Now, eventually, after 3 years, that has gone to 1, and we'll see more and more widening of markets and deep liquidity coming to these investments. Insurance companies were not allowed to invest in debt securities. Now, insurance companies and pension funds both are allowed to debt securities issued by InvITs. Another one, RBI in between said banks would not be allowed, and now banks are allowed to lend as well. Many guidelines with respect to, rights issue, preference issue, different kind of guidelines didn't exist when the first InvIT came in. Those guidelines are put into place, and including us, many other players have used them to raise rights issue, public preference issue. So that's something which is becoming into an asset class in itself. So again, very high level, the market is massive. We are seeing 3.5 trillion rupees of market. We've already seen REITs and InvITs raised over 9.7 billion INR for India. We see that this has a tremendous potential in new asset classes like HAM, renewable, hospitals, hotels, railways, airports, many other assets that can be owned by InvITs. And what that does is gives an opportunity for an Indian investor to own Indian asset in a safe, transparent, and liquid manner. The next. So why somebody should invest in InvIT, as I said, is very simple. It provides steady yield income. Depending on the business under the InvIT, it can be higher, lower, volatility can change. But it provides steady income because 90% of what needs to be earned needs to be distributed by investors. It is a good diversification in terms of investment because it provides a stable platform. Minimal execution risk, as I just said, minimum 80% of the asset needs to be completed. And most of the players have kept 100% completed. So that provides a far more stable outlook to the investors. There is a capital preservation and growth because there is stable cash flow getting earned. So the value is not changing materially. The cash flow over a longer period of time is stable. There is better corporate governance, better leverage because the leverage is capped. And this is something which offers it again as a safer revenue. So eventually when one does all this, what does that result in? It results into a superior risk-adjusted return for annuity assets. And that's something which is showcased below now. It's different InvITs and REITs are shown for different time period. But if you look at it, majority of the distribution that has come or return that has come from InvITs have come in terms of its distribution and then a little bit of price change. So what that does is that because they are high dividend or distribution paying entities, you see that they beat the indices or a bond or bank, etc. in a big way over a longer period of time. However, one word of caution, one needs to evaluate the business under the InvIT, and by no means I'm saying all InvITs or all REITs are same. The business under the InvIT, whether it is a toll, it's a commercial real estate or a gas transmission line or a transmission line, changes materially, and therefore one needs to study the business below that. And as long as the business is stable, annuity, you would end up having a more stable experience of investing. Just quickly to take through case study of Indigrade, we started with a vision of becoming the most admired yield vehicle in Asia, with a focus on long-term contracts and low operating risk projects, value accretive growth by acquiring more projects as we grow, providing investors predictable distribution quarter on quarter, and ensuring that we manage an optimal cap structure with a maximum leverage at 70 and do a liability management well. That was our vision when we started off. This has been the evolution that we have done in terms of growth. When we listed, we were 4,000 crores. Now we are about 21,000 crores. Investor base, this is something which is interesting, has changed materially. When we were launched, we were owned 16% by sponsors. Zero insurance company, retail holding was at 445 crores and limited institutional holding. As we stand today, 9 insurance companies own about 8.5% stake in Indigrade. Retail investor stake has increased from 440 crores to 1,825 crores. BII and FPI stakes have increased. Pension funds have started buying in substantially. So these are the material changes we see on the diversification on the investor side, which communicates nothing but the fact that more and more investors are finding it attractive to invest. We have covered some of the market development earlier in terms of approvals, so we can go to the next, please. There's again more details about Indigrade. We have about 21,000 crores and 19 states and duties put together. We own about 40 lines, 11 substations, and 2 solar power projects. Go next, please. Again, with the growth, our track record has been phenomenal. We have grown almost at a CAGR of about 50% on a year-on-year basis on most parameters. And with that period of time, we've also consistently increased the dividend that we have. Let's go next. This is how the superior risk-adjusted return has panned out. If somebody invested 100 rupees in June 2017 in different sets of investors, total return of Indigrade InvIT lasted much higher, largely on account of consistent, stable distribution. As you can see, the dark blue 46%, which is the majority part of the returns that we've offered. So even if a price didn't change, which is the gray box of 37%, we would have still beaten most of the indices just on account of distribution that is coming out of the business. And this is all at a beta of 0.07, which is a substantially lower beta that one can think of. This is very specific to the business, so we can skip it. But I think on the right-hand side is the important part. We focus on superior total return, sustainable increase in DPU, and stable operations. And pretty much these three should remain the same for all InvITs as a guiding factor. And one needs to evaluate their investment, that is, the InvIT or REIT they're investing in is focused on these principles or not. So with that, I would conclude my part of the deck, if that's okay.
Thank you, Harsh. That's quite insightful. With this, we move to the next speaker, and I would request Pratik to formally introduce Avinash Narvekar. Pratik, over to you.
Good evening, everybody. Good evening to the panelist and today's speaker. I'm highly obliged to be a part of such a good seminar and given a wonderful task of introducing today's speaker, Avinash ji. Avinash ji Narvekar. Avinash is a partner in the transaction tax practice of EY India. He is also a chartered accountant with over 25 years of post-qualification experience, and he has extensive experience in advising clients in the infrastructure and real estate sectors on the transaction and investment structuring, restructuring asset holdings, asset monetization, and identifying optimum operating structures. With this brief introduction, I hand over the proceedings to Avinash ji.
Yeah, thanks, Pratik. And I don't have my audio or my video on. I hope that's not an issue, but I'll try and cover some of the salient aspects. Now, obviously, speaking after Harsh, it's a bit difficult because he's pretty much covered everything, and he's really been a stalwart because he's been one of the the first ones to set it up and run it, get investors, right through the whole process as a listed InvIT. So he's touched upon I think pretty much everything. But what I'll do is maybe dwell a bit more on some of the points, especially as they relate to to retail investors. I'll certainly touch on the tax bit as well. But the tax bit, in a sense, is comparatively straightforward. It's not really complicated in terms of the tax implications. If at all, I think the structuring tends to happen vis-a-vis the entire, structure in terms of the trust setup, the holdings, the capital instruments which the trust owns, in the SPVs and so on, and how that is set up. Maybe I'll touch a bit on that as well. But before getting into it, the big picture, like Harsh said, right, is really that, and SEBI has looked at this in a fair bit of detail. They looked at the regulations prevailing across the world and tried to, so to say, get the best practices in. They have been very collaborative, in terms of, and happy to amend regulations if required as we go along. So a fair bit of amendments have happened as well. But the focus really of SEBI has been to look at protecting investor interests, which is their primary mandate as well, besides providing regulations for platforms where investor monies are pooled. And in that context, REITs, which is really for real estate, which has been defined. It includes not just commercial assets. It can include hospitality assets, for example, and other real estate assets. And separately for infrastructure investment trusts, so REITs and InvITs, a lot of the regulations are similar from a taxation perspective as well. The tax implications are similar, and I'll commonly refer to as business trusts as we discuss this as well. There are some fundamental changes, differences between the two, which I'll also talk about. But the intent was to allow asset monetizations for promoters and deepen that platform. and from that perspective, SEBI has admittedly brought in, some features which are a bit more conservative to protect investor interests. But the thought is some of them have been relaxed and they'll be further relaxed as we go along. So these are, more for ready assets. You can have a bit of underdevelopment assets as well, but mostly 80% would be in ready assets, which obviously reduces the risk profile because these are operating assets. You don't have development risks, approval risks, all of those. Not to mean therefore there are no risks at all. There would be certain risks still, but compared to let's say investing in equity, there is a difference between these assets and investing in equity stock. The other bit, which SEBI has done. So primarily in terms of protecting investor interest, there's a slew of measures, but the key ones would be: one is completed assets largely. The second one would be that there's got to be a distribution on an ongoing basis of 90% of the free distributable cash flows. So that's something which which again is kind of reducing the risk because that cash flow has to be distributed. Of course, it can be defined in a particular way, but largely distributions do occur for all the listed InvITs. Then again, there are got to be independent directors in the investment manager. So in that sense, again, there's looking at the risk in terms of management that's sought to be covered by SEBI as well. There's a whole slew of measures which the trustee needs to look at. So there's an oversight role for the trustee of the trust, which has got to be an independent trustee. There's a whole slew of measures for the investment, or requirements and responsibilities of the investment manager. There's a whole list of which assets you can invest in. In terms of also the valuation which an independent valuer has to provide and so on. So the point is several features built in to protect investor interest. And as a so to say an investment product, therefore, typically less riskier compared to equity. Of course, risk and reward go together. And therefore, in that sense, the upside will also, in a sense, be, so to say, within a range. It won't be unlike equity where there can be potentially significant returns and potentially significant downside risks, depending on, of course, various parameters and, aspects. But at least for InvITs and REITs, it tends to be range bound, which is really, again, a defining characteristic of, of this asset class. And the intent is to free up capital for developers so that, as well as for lenders to those projects to begin with. Of course, some of, debt capital does come back in the InvIT kind of structure. But the intent is to free up the original debt taken and then for promoters to free up their equity and provide a platform for that, to do that on an ongoing basis so that, InvITs and REITs are set up and developers can keep on, so to say, flipping assets into the REIT and InvIT into that platform as and when those assets get developed and ready and commercially operational. So that's the fundamental aspect as a product differentiation. Now, if you compare it with equity, and maybe we go back to the first slide. Of course, this is not to capture everything, but just to give some sense, right? So again, the asset listing is for operating assets. So mostly operating assets. This can be a bit of underdevelopment, but in the real estate space, you'll find that most of these till now, the REITs which have been listed are ready commercial buildings, which get rental income, right? And therefore, what it is. The projections are available. Not to say there are no risks, because obviously there is potential vacancy risk. There is potential risk in terms of how much the rents can increase over a period of time. But stable assets, and importantly, the ticket size for a retail investor is much lower. So otherwise, it's quite difficult, obviously, to invest as a retail investor or even for an HNI investor to invest in real estate property, because the ticket size would be higher, and then the liquidity is also an issue in terms of both the transaction cost for an exit as well as liquidity tends to be an issue. So this provides a good ready avenue. You know what the assets are, that's pretty much disclosed. There would be assets added, but again, there are, valuations would be provided, and, approvals would be taken of investors for adding assets. And therefore, it's a good opportunity to invest. And again, for listed REITs have to be listed. InvITs can be unlisted as well. But in this session, we'll talk more of the listed business trust. So, so the unit size, the lot size, recently it's been amended. So now it's just one unit, which can be traded. So which makes it much more accessible for various investors. These are obviously transferable securities, professionally managed. So the ones, what SEBI regulations have come out with are more, in a sense, geared towards developer, at least to begin with, sponsored and managed REITs and InvITs. But as you go along, you find that, you get investors coming in, some of the larger investors, global investors, who then also professionally manage it. And the team, of course, tends to be, quite independent and professional running it as well. So in that sense, and there's a list of qualifications for both the manager as well as the sponsor, which are prescribed. There is, since these were initially and still meant to be developer-sponsored REITs and InvIT, there's a minimum sponsor holding which needs to continue. So it's not necessarily like, promoter in a listed company, but there is a minimum holding. For example, for InvITs, it's got to be 25%, 15% in certain cases. For REITs, it's got to be 25% minimum holdings, which the sponsor needs to have. And that's more to ensure that the sponsor has enough skin in the game, and not that when it's listed at a valuation, which while there are enough obviously precautions built into the regulations, the sponsor also ensures it's not as if they can just list it and then walk away, right? So at least 25%. In a lot of REITs, for example, you find that the holding tends to be, in some of them, even beyond 50%, and only some of that has been divested to investors, when at the time of listing. Sorry, is it Jayesh presenting it? So maybe I'll just go back to the first slide. Right, so the return profile, like I said, will be range bound. There will be distribution, so there will be yield coming. So that's more or less kind of assured on an ongoing basis. Unlike let's say equity, where you may or not get dividends. 90% free cash flow has to be mandatorily distributed. There is tax efficiency. I'll cover that in a bit more detail in the tax slide, but it's fairly straightforward. And really for REITs and InvITs, for them to be successful, and that's been the global experience, and in a sense an India experience as well. It's quite critical that it's tax efficient, because otherwise, these products don't tend to do well. So it's not for Indian residents, as if tax incentives have been given, but the tax structure has been streamlined. So there's no leakages in the system. There's no double taxation. A lot of that has been streamlined. And further in the structure, and that's getting a bit more detail in terms of how the InvITs and REITs are set up, and what instruments the trust owns in the SPVs, how to get to that position. That is also, that also tends to be fine-tuned, so that the whole tax efficiency in the distributions from the SPV to the REIT or InvIT and then to investors is pretty much streamlined, both from a cash extraction perspective, which is critical, as well as from a tax efficiency perspective, right to the chain. The restriction on leverage that we discussed, restricted to 49%, for REITs and for listed InvITs. You can, take it up to 70% of the value if certain conditions are complied with, including, particular level of rating, including continuous track record of distributions, and so on. And also there are conditions where that money raised can be used for, what it can be used for. And therefore, in a sense, it's, both obviously, it's not comparable with investing in listed equity stock. There are risks involved which are potentially higher. There are gains which are potentially higher. But a REIT and an InvIT tends to have comparatively much lesser risk, more assured cash flow, and there is capital appreciation coming in right through as well. Of course, the price at which a unit may get traded may not necessarily reflect the intrinsic value. It might be lower or higher, but certainly in terms of there is capital appreciation plus the distribution which comes through. So for example, in the context of a REIT, since it owns underlying property, the REIT, which is a trust, may not own the property itself, but it owns shares of SPVs which own the property. That's the typical structure, though the regulations do permit a REIT to own the assets, whether real estate or infrastructure, directly. In the context of REIT, therefore, since the underlying property is real estate, there is a inherent increase on an ongoing basis as well as the real estate value increases. In the context of assets which are under a long-term lease, that valuation tends to be determined obviously by what rental income comes in and what are the escalations built in and how they progress over a period of time. But inherently, it's a real estate ownership platform, and therefore that provides significant upside valuation over a period of time. And it's perpetual. So REITs and InvITs, the platform is meant to be perpetual. It's not meant to be like a limited life, a 10-year or a 15-year. For example, if you were to invest in an AIF, you can of course exit before, but typically these platforms are set up to own the assets in perpetuity. And you would normally not find a REIT or an InvIT selling any of the assets it owns. On the infra side, again, the nature of appreciation, it depends on the nature of assets as well. So infra, there's a whole long list of what all infrastructure assets can go into an InvIT. And presently we have about 7 to 8 InvITs already up and running. And as Ernst & Young, we pretty much worked on the structuring for a majority of these InvITs, right from the time of setup and from a distribution. Therefore, the tax aspect, like I said, from a retail investor perspective, are straightforward. The aspects are more on the structuring which comes in. But for InvITs, really you'll find roads, and there are a few of those road assets already in. You will find transmission towers, Indigrade, for example. And those assets, already, InvITs which are there. You will find telecom towers. There's a gas pipeline InvIT. So in terms of the variety, and that only more assets will come in. There are InvITs being proposed for renewable assets as well. And fiber optic lines as well. So all infrastructure assets at some point in time potentially could come under the fold of in an InvIT. You might also find that developers adopt a dual approach, that they have the development business which is listed, and then you also have an InvIT sponsored by the same developers. And what happens is, once the development assets are constructed and ready and income earning, they are flipped into the InvIT structure, and that tends to provide better valuation than continue with those assets in the main exchange listed entity. So it's a platform which is there to stay. You'll also find that especially in InvITs and also for REITs, the intention is not to just stay with the original assets. You'll keep on adding assets. Like Indigrade, for example, keeps on adding assets. And therefore, it's not a case where, because typically some of the roads, for example, will have a concession agreement with an HA or with a state authority, for example, and that will be for a limited life, right? So the platform might be perpetual, but let's say the concession is for 20 years. So post 20 years, that concession will cease. But you'll find that these platforms keep on adding assets. So in that sense, it's a growing platform, and a premium tends to also go to to the InvITs and the REITs, which demonstrate that they keep growing the overall portfolio, and potentially therefore, and not necessarily potential, and therefore also the overall value also tends to increase over a period of time. Because once you have the ability, the team, the management, which demonstrate that, that tends to attract better valuations as well, as compared to, for example, a single or a two asset InvIT, but the intent is not to keep on adding assets. So going back to the earlier slide, let's stay with the diagram now. And Harsh did talk a lot about that, but we will just speak on a few points here. So the structure is that the REIT and the InvIT necessarily has to be a trust. So that's a trustee, which has got to be an independent trustee. A REIT has to be necessarily listed. So the units of the trusts are listed. It's not shares of a company. InvIT, you can have listed and unlisted. In the context of obviously, listed InvITs, the units of the InvIT would be listed and freely tradable. The way the process works in terms of setting it up, you would have, while the regulations, like I said, allow the REIT or the InvIT to own the assets, but that's not very efficient, even from a taxation perspective. So what tends to happen is that you will find that the REIT or InvIT owns SPVs, or there might be a holdco below the REIT or the InvIT, which further owns subsidiaries being the SPVs where the assets are located. So that's the typical structure in all the REITs, InvITs which have been listed till now, and that's likely to continue going forward as well. Now the trustee has to be independent. You also need a sponsor to the REIT or InvIT, just like a promoter of a listed company. And there are certain minimum, responsibilities, obligations of the sponsor, including owning a minimum percentage stake over a period of time, so that there's enough skin in the game for the sponsor. But really, the sponsor is the one who sets it up, and therefore the sponsor, typically the SPVs which the sponsor owns and which are mostly ready and up and revenue generating, get, so to say, swapped with units of the REIT. So that's a swap which happens. They go to the InvIT as a transfer, and in return, the sponsor, based on the agreed valuation, gets units in the REIT or the InvIT. The REIT InvIT also needs to have an investment manager. The investment manager typically is also owned by the same sponsor group at the time of setup. But subsequently, you might find that some investors take a majority stake in the REIT or InvIT, and then they buy out the investment manager as well. And then effectively, then the REIT InvIT is not then just the investment manager, is also kind of a professional investment manager. But like I said, even if it's a developer-owned investment manager, there had to be majority, at least 50% of the directors have to be independent directors. And in the context of an InvIT, you also need to have a project manager, which is not required for a REIT, because the infra assets require much more expertise to manage them compared to let's say a real estate commercial building. Again, the project manager is someone who typically tends to be of the same sponsor group to begin with. And then you have all the SPVs below that. So it's a swap. That's how it's set up. And then you will have the investors coming into the REIT or the InvIT at the time of listing. That could be partly through an offer for sale of some of the units which the sponsor owns, which they opt in through a swap. And then there could be a fresh issue as well by the REIT or InvIT to get the cash into the REIT and InvIT, which might then be utilized to, for example, pay down the leverage which might be existing in some of the SPVs below and so on. Or it might be utilized for, if there are certain development assets, then utilized for those purposes to complete the development in the SPVs. Now, from a structure perspective, right? So what is important is there needs to be ability, both from a cash extraction perspective and a tax efficiency perspective, because the cash flow really will come at the SPV level where the assets are located. And those, at that level, then you could have external debt, subject to the overall limit, 49%, like I said, that's a total limit in the REIT InvIT as well as the SPV level combined. And you used to service it at that level, either the SPV or the REIT InvIT level. And then the balance cash flow has to move up to the REIT InvIT. That can go up either as interest on any loans or debentures the REIT InvIT has in the SPVs, or as dividends on the shares, or as repayment of the loans, or as capital reduction and so on. And from the REIT InvIT, it goes to the unit holders really as distributions, because these are not shares, it's just a distribution. For tax purposes, there are some deeming provisions which say that this should be treated as what's the character of the income of the distributions, but as a as the money is provided or sent to the unit holders is really just a distribution from a legal parlance on the units. Now the challenge tends to be that like Harsh also briefly mentioned, that in these SPVs you will have book depreciation. In infra, for example, it's asset heavy, and therefore that is not money, because the book depreciation you might have cash, but you don't have profits, and that money can't be sent up. So normally you'll use that money to service the lenders, the principal of the lenders at the SPV level, but any leftover can potentially be an issue. So the structuring aspect there is to see how you can get to a structure. That's getting into a bit of detail, so I won't cover all of that. But ideally what you'd like is the REIT InvIT from cash extraction ability perspective, not just to have shares in the SPVs, but also to have debentures and loans in the SPVs. Now there might be some loans or debentures which already exist when these SPVs were set up and the shareholder contributed monies, but those may not be sufficient. So we need to see how do you get to increase those loans, debentures, and what's permitted in the Companies Act from a tax, from a taxation perspective, how do you get that, do that efficiently and so on. And that's how the money will come up and then distributed. Now let's take an example that from the SPV, a distribution is, let's say 70 of interest to the REIT or the InvIT, let's say 20 of dividends, and let's say 10 is a repayment of loan from the, or let's say 10, just an example, it may not be that much, but let's say a distribution from the SPV to the REIT InvIT as a repayment of loan or debentures the REIT InvIT had in the SPV. And this 100 is distributed by the REIT InvIT to the unit holders. Now, from a taxation perspective, what happens is, since this is just a distribution, there are some deeming provisions. So for unit holders, the taxation is of, the distribution takes the same character and the same proportion as income received by the InvIT. Right? The InvIT or the REIT is otherwise a tax transparent entity. So once, let's say the 70 is paid as interest by the SPV to the REIT or the InvIT, the SPV will get a tax deduction against its corporate tax profits of the 70. So there's a tax break at the SPV level. The REIT InvIT, if it receives interest, it's a tax pass-through, so no taxation at the REIT level. There is no withholding tax when the SPV pays interest to the REIT either, so there's no cash trap there. And once the 100 is distributed, 70 of that distribution is in the character, it takes the character of interest, because that's the nature of income received by the InvIT. So it's a deeming provision. The REIT InvIT will provide a disclosure to the unit holders in terms of the distribution, what is the nature of income and what is the proportion of that income in terms of different characterization. Similarly, the 20 of dividend received by the REIT InvIT, no withholding tax when the SPV pays dividend to the REIT or the InvIT, no taxation at that level, trust level. And of the 100 of distribution, 20 takes the character of dividend. And the 10 which comes up, right, as a repayment of debentures, let's say from the SPV to the REIT InvIT, that of course is not a taxable income for the REIT InvIT, and that distribution to the unit holder as well will go more as repayment of the unit value. And again, not a taxable item for the unit holders, typically. Now, of course, this can get into aspects around what happens if there's a secondary purchase of unit, which will obviously happen quite regularly. And if that's purchased at a, just as a hypothetical example, at a discounted value, and eventually the whole par value of the unit gets repaid over a period of time. Then, then there would still be a capital gains for that investor compared to the investor who came in at par value upfront. So some of those instances or, specific situations would arise, but typically repayment of, unit capital would not be taxable for the unit holders. So that's the, so from a taxation perspective, in that sense, it's fairly straightforward. The unit holder will be informed what is the nature and character of that income. Now, now to incentivize REITs and InvITs, the government did give benefits, right? Now these benefits are across various, steps of the transaction. So for example, when the sponsor swaps the shares of the SPVs with units of the REITs, that's treated as a non-taxable transaction, even if the sponsor company, let's say, is still under the old tax regime and otherwise subject to MAT. MAT also does not apply. So that's an exemption given at the time of swap. And the sponsor would be taxed only to the extent of the units which they sell, right? So if they were to sell, let's say 75% of the units, their taxation is only on the 75%. The cost of the units is the same as the cost of the shares which was swapped, and the holding period of the shares is counted, for determining whether it's long-term or short-term when the units are sold by the sponsor. So that's one set of provisions more for the swap and the transfer. Like it's, the REIT InvIT, like we discussed, there's no taxation at that level. They removed the withholding taxes, otherwise it results in 2 layers of taxation for distributions by the SPVs to the REIT and InvIT. Otherwise, if there were to be withholding, then the certificate is in the name of the REIT InvIT, which is a non-taxable entity, and that creates issues. The REIT InvIT, when it distributes, there's a 10% withholding for resident investors, both for interest income in the nature of distribution, in the nature of interest and dividend. There's a withholding, but for resident investors, the interest and the dividend would normally be taxed at the normal rate of tax. So you have to pay the difference, or they have to pay the difference compared to how much has been withheld. So if the rate is, for example, 34%, effective tax rate, then 10% has been withheld. The balance tax has to be paid. However, there's a concessional rate for interest or distributions in the nature of interest to non-resident shareholders provided by the Income Tax Act, and that rate is 5% plus surcharge on sales. So there's a differential given for non-resident investor in terms of a much beneficial, tax rate. Of course, non-resident investors also get treaty benefits which provide for a lower tax rate, but 5% is seen as even more concessional compared to treaty rates. And the reason for doing this was that you're finding that a lot of these assets were being listed in Singapore. So, business trust listings for Indian assets were happening in Singapore. And the government felt there's no reason why we shouldn't develop a platform to have these listings in India. And for that, it was felt that we need to have these tax concessions given. Since a lot of money in these REITs in which does come from, foreign money, given the quantum of investments which are required. So again, summarizing, I think we covered most of this, but just in terms of some bits which are not covered on the tax rates, on the capital gains, the tax rate is 10% for long-term capital gains. Long-term year is 3 years, unlike for shares which is lower. So in that sense, it's a 3-year holding period for it to be long-term, and for short-term, it's 15%. So that's again a lower concessional tax rate. It's not the typical long-term capital gains tax rate for which would have been around 22% for residents. So this is a much lower tax rate which applies. There are also some aspects around which anyway don't tend to be deal breakers, but there are aspects which come into play around would transfer pricing apply for payment of interest between the SPV and the trust. If the trust is foreign owned and controlled, would the thin capitalization norms apply? Because interest eventually, most of it might be going for non-resident investors in terms of when the interest is paid by the SPV to the InvIT and so on. There is more and more clarity which is coming on some of those positions. But otherwise, it's it's something which the way it stands today, there's much more comfort in terms of efficiency on tax and so on. There's one other bit which is relevant is in certain cases, even dividend income, especially in the context of REITs, but also in the context of InvITs. You'll find that in certain cases, dividend distributions in the nature of dividends received by unit holders, that is also exempt from taxation. And that can obviously provide just from a taxation purely at the retail investor or investor level, unit holder level. If it's exempt, it's seen as more beneficial. Now that exemption is earlier, there was a change in law earlier because we had DDT, right, dividend distribution tax, which applied at the SPV level. And that point in time, for business trust, the tax provision said that the DDT would be exempted or was exempted. Then the law changed where DDT was abolished and dividend is now taxable for shareholders. They didn't change that, and therefore there was a period of time where dividends received by unit holders was becoming completely taxable after the shift from DDT to taxation in the hands of shareholders. Then there was a lot of, there were representations made, because obviously DDT was exempt, dividend should also be exempt for shareholders. And then there was an amendment brought in, but it was a conditional amendment, which basically said if the underlying SPVs below the REIT or the InvIT, if those SPVs are under the old regime of taxation, which is not the concessional 25% rate, but the old rate and MAT also applies. In that situation, dividends distributed by these SPVs to the REIT or InvIT and then ongoing characterization in the hands of the unit holders to the extent is dividend, such dividends would be exempted in the hands of the unit holders. So that exemption is available. However, if the SPVs elect to go under the new concessional tax regime, right, which is the 25% rate, then the dividend distributed by such SPVs will continue to be taxable in the hands of the unit holders. So that's again a disclosure. When distributions are made to unit holders, the REIT or the InvIT would provide that clarification in the correspondence in the prescribed form to unit holders to indicate whether it's exempt or whether it's taxable. So largely on the taxation bit, that is kind of the summary. Of course, there's nitty-gritties around it. But maybe I'll just open it up for questions and then we can try and address those.
Thank you, Avinash. Ankit, you want to take up the questions?
Yeah, I'll do that. So first, I would like to go to Harsh. There is an interesting question. Can a corporate group have control over the InvIT? That is the question. He's just elaborated further, stating that why he's asking is to understand, since the primary motive of forming an InvIT is to attract investments from public for a relatively low beta asset and ensuring a good dividend distribution per unit and liquidity. For a corporate house, how is it different from incorporating a subsidiary vis-a-vis forming an InvIT?
Okay, so first question, I think to answer that question, corporate can control an InvIT by different means. First one, by controlling the investment manager, because investment manager is the one which operates the InvIT. So if by way of controlling the investment manager, one can control the InvIT. Second one is by way of becoming a majority shareholder of InvIT and therefore having a say in most of the decision that you decide, or InvIT decides indirectly. Because if 20% of unit holder of an InvIT comes together, they can change the investment manager. So that's a kind of another form of control that one can exercise. So it can have. Now the second question, if you can clarify that the purpose is to monetize, but an InvIT a company. Is that the question?
So he has just basically, extended the thought in terms of why he feels that probably a corporate can control it. Is that, instead of forming a subsidiary, which will look at those assets which are low beta, and it's only they would probably start forming InvITs for that same purpose and try to separatize those assets from their own on books to the books of InvIT.
Correct. So I think that is the fundamental model, right? You need to sell the asset and instead of SPV, make it an InvIT, which will become a low risk InvIT if the assets are low risk and therefore attract better capital. But on the other hand, the one will need to follow the InvIT corporate governance norms, which are substantially superior than an unlisted SPV that you own. So by virtue of somebody making an InvIT, they are recognizing that we are going to live up to a higher corporate governance norms, leverage cap, better dividend threshold, etc. So they are doing the right thing. Control or no control depends on whether they are controlling the investment manager or how much they are keeping of the InvIT with themselves.
True, I would agree to that. From there, I would move on to Avinash ji. Avinash ji, there is a question from one of the participants, which mentions that as per section 47(7) of the Income Tax Act, any transfer of a capital asset being share of a capital, share of a special purpose vehicle to a business trust in exchange of units allotted by the trust to the transferor is exempt. Now, SPV has been given the same meaning assigned to it in the explanation to section 1023 FC of the Income Tax Act, an Indian company in which business trust holds controlling interest and any specific percentage of shareholding or interest as may be required by the regulations under which such trust is granted registration. So the question is, accordingly, should REIT have a pre-existing controlling interest in an SPV in order to be eligible for claiming exemption under section 47(7) of the Income Tax Act? If an SPV transfers shares to a newly formed REIT, which does not hold shares of an SPV earlier, then would it still qualify for the exemption, or would it not qualify for the exemption?
Yeah, no, it's a fair question, and this the wording in that section could have been better. This has been represented to the government in terms of because otherwise it's a non-starter, right? As you transfer it, that's where you're getting the exemption, so you can't be pre-owning it to begin with.
Right.
But having said that, this position and the intent and the explanatory notes and given all of that, pretty much the positions have been taken for all the REITs and the InvITs which have happened that this exemption is available. But this, ideally this should be clarified. The expectation was this should have been clarified long time back, but it hasn't been. But the position being taken is the exemption will still hold.
Okay. So Arjun, next question that I have, which typically I think all the investors would have had in mind, is what is the rate of return on an IRR which a retail individual can earn on such instruments, and what is the risk profile for as an investor? What is the risk profile I should have if I'm looking at investing in such instruments?
So, see, IRR depends on what InvIT you buy, what risk you buy. Different InvITs, REITs will represent different kind of investment, different kind of avenues, right? So, very difficult to comment on what is the IRR they offer. Depend because several aspects. One, at what price point you bought, right? At Indigrade, you bought at 100, 85, 140, the value or the return parameters change. Whether you buy a transmission InvIT or a road InvIT, the value changes. A road toll and a road annuity, IRR changes. So IRR is a function of risk that you're willing to take and how much you understand that. So lower the risk, lower the IRR, theoretically going to be, and higher the risk, higher the IRR. Not necessarily, sometimes higher risk gives you lower IRR and lower risk gives you better IRR. So the correlation is not very clear, but one needs to focus on what is the risk that they are willing to take and accordingly buy that, and at what price they are buying into it. So it's dynamic. Today it's X, tomorrow it can be X plus 1%, X minus 1%.
Thank you. There is another question, though I believe it has been answered, but nevertheless, given that there is no downside to the value of a unit, practically very less, I don't know if you would agree to that. If it's not, then I would like to throw some light on that as well. And how can one decide an exit?
Okay. So see, downside is pretty much linked to risk, and IRR and this question is linked with each other. There is a downside in it. At the end of the day, it's an equity type instrument. There is no legal promise that is getting made. Not that in equity also anything getting made. So point one depends on the asset class, right? If you buy a concession asset in the last year of the asset, the next year ke baad value is going to be zero, right? So one cannot figure out that just because I'm buying it, there is no downside, right? However, in an annuity-like assets with sufficiently long concession agreement or assets, the downside is limited. I won't say zero again, but limited. The reason being that the cash flows, if the cash flow of the business are strong and predictable, then only the market changes would determine the prices because the cash flows would continue. With the market changes also, I mean, we have seen COVID scenario and reverse of COVID, everything we have seen over the last couple of years. Price can go down 30%, it can come back 30%, right? Like any other security or asset for that matter. So it depends on the type of asset you are buying in. Typically, annuity asset with long-term concession will have relatively lesser downside in comparison to GDP-linked asset, which has higher volatility.
Another question that we have, Avinash ji, is 112A not applicable. So LTCG in the hands of REIT would be taxed at MMR?
Yeah, that's correct. So, because, these REITs, these platforms are not really intended, and they don't intend to actually buy and sell assets, right? So, and therefore that's going to be extremely uncommon. But what has been done is the pass-through status, has been firstly given only for interest and dividend. But in the context of any capital gains, firstly, and then I'll come to that, the rate of tax. In the context of any capital gains, that continues to be taxable at the REIT or the InvIT level. And then, those amounts distributed to unit holders are exempt because tax is already paid then at the REIT or InvIT level. Very unlikely to happen. You will, hardly find any REIT or InvIT selling any of the SPVs. That's not the model for which they are set up. But if they do, then the tax rate would be the capital gains tax rate. And even in the context of MMR, the position is if it's a capital gains, you can still apply the capital gains tax rate and not the full rate in that, given the nature of the income. But however, if the REIT, you can also have, for example, some income which is surplus cash lying at the REIT or InvIT level, right? For a shorter duration, it may not be distributed because again, the distributions may not happen every day in that sense, right? It will be periodic, quarterly, for example. And then in the interim, if there are liquid funds and income earned, right, on those liquid funds, which is again not interest or dividend received from SPVs. Now that income again is taxable at the REIT or the InvIT level, and that post-tax income distributed to unit holders is exempt in the tax of the unit holders, and that income will certainly be taxed at the at the REIT or the InvIT level at the MMR rates.
We have some hands which are raised if you want to allow them.
Sure. So we have Mr. Rajiv Sheth who is there. I would unmute him and ask him to come on. Bhavik, you will have to allow them to come in. I am not authorized.
I've allowed Rajiv.
Hi.
Rajiv ji, you are there, yeah.
Yeah. Basically, I just wanted to know whether the InvIT or the REIT is perpetual or not.
It is a perpetual platform, and legally speaking, it's a perpetual platform. However, the assets under which may not be perpetual. So sometimes, let's say if you buy a road concession which ends in 10th year and there is nothing that the manager or somebody did, it exists as an empty shell after that, but the platform is perpetual. There is a delisting process governed by SEBI. But to answer your question straight, it's a perpetual platform.
And to add to that, suppose if concession period is over, then there is no asset is left, then what you will return to the unit holder? Nothing.
Nothing so, will be returned to the unit holder. So there is no obligation to return something to the unit holder.
Okay, fine. Thank you. Thank you.
Bhavi, can allow Dr. Kishore NK to be.
Yeah.
Thank you, leaders. I want to understand, when depreciation is part of the distribution, why are the REITs being taxed in the hands of owners? Actually speaking, if each of the owner is owning a part of the asset, when the taxation should be only on the profit after depreciation. But why can't this anomaly be addressed in the REIT structure? It's taxing the principal as well. The capital what you are paying into the asset is also being taxed as if it is a profit, which is not the case actually.
Avinash, you can go first, then I'll add.
Yeah, no, you anyway, Harsh, can answer everything, but I'll anyway, but just on the question, didn't quite fully follow. So in terms of you saying any capital repaid, Kishore, to the unit holders, that is also getting taxed. What was that the question?
Yeah, when the whole of the money is being, the complete revenue is being distributed, receipts. Effectively speaking,
yes. Yeah. Well, the complete money, it's not as if, if the SPV, let's say, gets, in a let's say in a road asset, right, gets 100 as toll revenue, right? So what would happen is at the SPV level, there is depreciation in the books, right, in terms of amortization of the cost incurred for setting it up, right? And then you will have the O&M costs which are coming there on an ongoing basis. And then you will have, if there are loans, which there would typically be at the SPV level, you can move that up to the InvIT as well. Let's say at the SPV level, you will have the interest on that and the principal repayment on that. All right. So what will happen is, when the SPV firstly sets up when the promoter sets up the SPV, it would contribute monies, right? So it will contribute equity, and I'll just take a different numerical example. Let's say it contributes 30 of equity and 100 of, and 70 of, it takes as external debt, right? And you spent 100. There's a capital asset created of 100 in the books of the SPV. And then on this 100, this capital asset, let's say you're getting toll revenue over a period of time. Now against that toll revenue, first is, any operating cash expenses like O&M expenses and management expenses, overheads, you'll obviously from a cash flow perspective, that will go out, right? Any loans taken, that 70 of loan taken at the SPV level, interest on that will go out, right? You will also, over a period of time, the depreciation or the amortization, which is debited to the P&L in the books of the company, really reflects a return of the capital, right? But not to be paid out as dividends. It's it's the 100 which was originally invested, it comes back, and your balance sheet, if all the profits are distributed, everything comes back at the end, will just look like equity of, of 30, 70 of debt if you had not repaid. Of course, you're going to repay debt, and 100 of cash. Now 70 will also get repaid over a period of time, right, with that cash. And then your balance sheet will look like 30 of equity and 30 of cash. Very, from a theoretical perspective. Now the free cash flow which gets distributed, which, which SEBI has also provided guidance on how that should be, calculated, is meant to, your top line which you receive, your operating cash flows, servicing of lenders, and that is the free cash flow which remains. Now, now some of that free cash flow may not reflect as profits in the books, because maybe that was the point, Kishore, you're making, that some of it is because of depreciation, you have cash, but you don't have book profits, right? Now that typically gets stuck in the company, right? At least over a period of time. You'll have, from time to time, there might be mismatches, because you might have ability to send out, if there are shareholder loans from the REIT InvIT, you can send that money out initially as well as a repayment of capital. But from a taxation perspective, it's not double taxation, right? So ultimately, what the unit holders get back as repayment of unit capital, or even the REIT InvIT getting back the unit capital, that is not taxed. What is taxed is only the profit, right, made by the SPV and then distributed, either profits or interest paid, which is a debit to the profit. So either interest or dividends get taxed for unit holders, but repayment of capital doesn't get taxed. Harsh, I don't know whether you had a different context to this. And
No, I think that you covered it technically. Conceptually, I would just say that, see, you get dividend, you get distribution in three forms: interest, dividend, or principal repayment. And the proportion varies based on business and cap structures. But when you get it in the form of dividend, it is after paying tax. So it's the same treatment like for any other dividends. When you get it as a principal repayment, you don't have to pay tax on that. And third, when you pay tax on interest, because you have taken SPV level deduction of that interest payable, therefore investor will end up paying tax in their hands. So from a tax guy perspective, they sum it up and saying no double taxation, but different capital structure will have different things. In some cases, depreciation will match the principal repayment. In some cases, it will not match. So it is different for different assets, but in principle, conceptually, there is no double taxation, because whenever the company, or rather the SPV under the InvIT, chooses to repay the money as principal repayment back after paying its interest and dividend, then there is no tax that investor has to pay. So it's already to some extent taking in principle alignment that there is no double taxation.
Okay, thank you, sir.
So the last two questions, one each, I would just say. Interesting question one we have is, since these assets are fairly priced and closely follow the interest rates as seen globally, this seems to be the bottom of the cycle. How do you see this asset class from a 5-year, 10-year perspective, making returns on capital appreciation perspective?
So, okay, difficult to predict both interest rate and returns, but I would say that the point is right. They are closely connected to the interest rate cycle. And if interest rates are low, the asset values go up. Interest rates are high, asset values theoretically should come down if there is no ability to pass through that cost. So one needs to keep that factor in mind. However, the moment you take 10-year consideration in mind, and depending on what yields you buy, let's say you buy something at a 10% yield today. That means in your 10-year horizon, the 10% into 10, so 100% distribution is going to come to you anyways in form of dividend or yield or something, right? And then what happens is, whether your investment became 100K 120 or 100K 80, the impact on 10-year horizon is lower. Because in 10 years, you earn 100 rupees or 100 rupees as distribution on a 100 rupee investment, and 20 rupees of loss or 20 rupees of appreciation, that only adds 2 rupees of annualized increase or decrease, right? So the moment you take longer period of investment into consideration, the impact of capital appreciation or depreciation reduces, because the majority part of your returns is coming out of the distribution and ability of projects to earn that distribution, right? So one needs to be very careful on that. The price changes impacts you in the shorter run, but if you hold to maturity or hold for 10 years, the variability on account of price goes down materially.
Thank you. Last question for Avinash ji. Avinash ji, how to account for capital gains is the question. The facts of the case that has been presented is issue price of the InvIT is 100 rupees per unit. There is an income distribution of 2 per unit. Capital paid back of 3 per unit. Purchase from market. So there is 2 cases. First case, purchase from market at 110 per unit. And the second case, purchase from market at 60 per unit.
Right. Okay. So, well, in terms of, it's more in the context of the distribution, and some part of that is, takes the character of a capital repayment, right? So, however, you'll find that in both these situations, at least when the distribution is happening, there is no transfer of the capital asset. You still continue to own the capital asset, but some of the capital has been repaid through a distribution. Right. So in that sense, there is no trigger of capital gains at the time of distribution, part of which is capital, by while you continue to own the REIT or the InvIT unit. However, in both those cases, right, when you eventually exit, What you need to do is, to the extent you got the distribution, the 3 rupees, I think in that example, or whatever comes during your holding period, you will have to reduce it from your cost. And therefore then see what your sale consideration is, and then reduce the net amount after reducing that distribution, which was a capital repayment which came in. So it's, so that you can't say that that capital repayment which you got, I'm not going to treat that as a consideration, but it's added to the consideration when you actually transfer the asset. In the interim, while you hold it, you're not transferring the asset. So that's the way it would typically work.
Okay, thank you.